This is Mark Trice with ClearVista Financial, and this is the July monthly market update, our perspectives here at ClearVista Financial. And we're glad that you've joined us today. We got a lot of information to cover today. Sorry for the red dot. I want to use it a lot today, so pay attention to it. Let's see here. I'm going to keep the camera up, I think, this time. If I get tired of looking at myself, I will turn it off. All right, so we'll update the market in June. A lot of activity. The markets went up quite a bit in June. We'll talk a little bit about the economy and how that is faring. And we'll also talk about how it impacts you. We're going to get into a lot of economics today. So for those of you that are not economically inclined or quite the geek like I am, I apologize, but there's some relevant information to explain and also disprove a number of myths that are out there about the state of the economy. And then finally, we'll talk a little bit about the, depending on your political persuasion, the big beautiful bill or the big ugly bill. And we'll discuss that a little bit and what's true and what's not that you're hearing in the news. So let's jump in. You can always send us your questions at 254-282-0495. I will keep an eye on the text line here to be able to follow that. And if you have questions, we'll try to answer those live on the program. And let's get started here. All right. You can also send us an email to info@clearvistafinancial.com. I'm not likely to see that during our broadcast, but I will respond to it later on. So let's review the markets. So the second quarter is done. We're halfway through the year, and the markets did well in the second quarter. The S&P was up a little over 10.5%. The NASDAQ up 17%. The Russell up 8%. Long-term treasuries were down in the second quarter 3%, which is something we'll discuss. And then the moderate index was up 4%. Now, don't get too excited. That does not mean that year to date these indexes are up that much. But what it does mean is that the markets have settled down with tariffs and things and the uncertainty there. The tax bill that's continuing resolution is actually what it is. Going through Congress right now is going to extend tax cuts probably. We'll see later today. And markets respond well with less uncertainty. And so we saw that this month, and that's a good thing. I wanted to show this here of the S&P 500. I went back through early in the year, and this blue line up here at the top is really the high water mark from a couple of different times. You can see we hit that, close to that in January, another hit on it in February, and then the big 20% plus decline in the month of June there. And so we had a nice rebound in April, May, and June, but we're just now hitting back to those all-time highs. And the thing is, the reason I put the blue line here, folks, is this is an area of major resistance. Now, the last couple of days, we are above that. Here is July 3rd, and the markets are up again today. Yesterday was a little bit flat and so forth. But if this holds, then we can probably say that the market will continue higher. More than likely, though, I expect, and it's just been my experience, that there'll be some retracement. And then if it rebounds and breaks through this mark again, I think the markets will continue on up. Now, we're in the middle of summer, which oftentimes is a lot of less trading volume and things like that. But we see this as a positive sign that markets are improving. We still don't have the breadth of growth in the market like we'd like to see, but this is a good sign. Same thing with the NASDAQ. Now, this is a little bit, this goes back all the way back to 2000, back in the 2020s. And the NASDAQ hit all-time highs back in December. They hit them again in January, February, but we just couldn't break through that. And finally, in the month of May and June, we broke up to an all-time high in that month. We'll have to see, does that hold? The very next day on July 1st, the NASDAQ pulled back quite a bit. So we'll have to see if that holds. If it continues on up, I think that will be a positive sign for the markets. It's important to distinguish between the markets and the economy, because the markets behave differently than the economy might behave. All right, here's the Russell 2000 index, and I drew this all the way back. Well, I didn't put it in here the way I wanted to see it. I must have captured a different picture. The all-time highs here, we're back here in no, not all-time highs. We hit a high water mark back in December, which actually was the first time we touched that high water mark, which went back to 2021. Okay, that's important to remember. We still have not recovered and recaptured the all-time highs that took place in the fall of 2021. Let that soak in for just a little bit. It's been 4 years, almost 4 years, since the Russell 2000 has hit an all-time high. And that's important because when we see growth and expansion in this Russell 2000 index, remember these are small companies on this index, we see more robust breadth in the market. And we're still not seeing that. Large caps are still driving the wagon here, and small caps hopefully will recover. But you can kind of see a nice steady climb up, but we're a long ways away from that level. And I should have been telling y'all the June and year-to-date numbers on the other indexes. I did not. I apologize. S&P through June is up 5.5% year-to-date. NASDAQ up 5.43%. The Russell 2000, the one we're looking at now, is down for the year minus 2.3%. And let's take a look at long-term treasuries here. Now, I went back to 2020. This chart shows going all the way back to 2020. And you can see that long-term treasuries have been going down, down, down. And I was thinking of an old 1950s barbershop quartet thing. Anyway, we've been going down. And year-to-date, the bond long-term treasuries were actually up 1%, just a little over 1%. In June, they recovered, but June is right in here. They recovered 2.2%. Long ways to go, because this back here in 2020 signaled the end of a 40-plus year bull market in bonds. Can you believe that, folks? 40-plus years of a bull market in bonds had come to an end, and it was primarily because of the rapid rise of interest rates during the high inflation periods. Moderate index in June, up 2.8%. It's positive for the year as well. And we see there the blue line. That is the all-time high. That goes all the way back to 2021. And we still have not quite captured that all-time high again. So, but positive signs, you think about it, it's taken us 3 years to really grind our way back up. And that slow and go is the way sometimes the market goes. Here's our disclosures. Please read them carefully. There will be a quiz at the end of today's program. Just teasing. All right. So what effect has the tariffs and things and the tariff delays had on the market? Well, one of the interesting things that we're seeing is a trend that we're seeing observe, and we've talked about this in previous broadcasts before, are corporations that are buying back their own stock. Now, the effect that this has is it buoys or even raises the price of their stock. We saw there was an expose, I think it might have been 60 Minutes or something, that did this going back, over a decade, tracking Boeing and how Boeing would prop up its stock price by initiating buybacks and thus creating their own demand for the stock, thereby raising the prices or causing the prices to go up. You can see here that in the last decade, 2025, only halfway through the year, 2025 have had the most corporations announcing stock buybacks. This means that the corporations, the stocks themselves are producing their own demand. In other words, it's not retail investors that are coming and screaming, I got to have this, fear of missing out. It is the actual companies themselves that are buying back their own shares to keep their stock prices stable, or even buoy them and make them go high. This information, a lot of these slides today came from one of our custodians, Asset Mark Trice. We appreciate them. And you'll see those footnotes down here on the bottom whenever we do that. Okay, where are we in the seasonal volatility of the S&P? July normally is a quiet time. You can see here that it's usually below average. Now, there's a couple important dates that are coming up that we'll talk about in a moment, which might increase volatility in the market. But generally, the doldrums of July, markets are very quiet. Historically, it's a fairly positive month going back in history. Does not mean that will repeat itself again. There are plenty of things that can cause turmoil and chaos. I mean, we just got through with a 2-week war with Israel and between Israel and Iran. So lots of things can potentially disrupt that. But typically, this is a quiet time, if you will, in volatility in the markets. And we are seeing that this week as well. Okay. Just a reminder, you can text your questions to 254-282-0495, 254-282-0495. And let's jump into the macroeconomic stuff here. All right, so June, the Federal Reserve, Uncle Jerome, as we affectionately call him, the Federal Reserve held the overnight Fed funds rate steady, but they did include some language in their minutes and in the press conference that they still expect 2 more cuts by the end of the year. Now, this is significant because this is what the market wants to hear. There are a lot of data right now that might prevent the Fed from doing that in their July meeting, but more than likely they'll wait till the September to make those cuts. They have also lowered their growth forecast for the economy to 1.4%. We'll talk about that just a little bit in a moment. And unemployment forecast was raised to 4.5% by year end. Right now, employment data came out today, and the unemployment rate fell to about 4.1%, but we'll have to watch that. Still a lot of time left to go this year. The consumer price or PCE inflation forecast increased to 3.0%. Not a big deal, still within range. The CPI has been raised to a 1.0 annualized growth rate, which means inflation is calming down. So the dot plot basically said that most people wanted to hold on cutting rates right now, and they'll let that be data-driven. The only challenge when the Fed waits on data to make these decisions is they're often behind, but that's the way our system works. Despite the headlines with Trump calling Powell to be stupid, I think they're going to hold rates and not cut them anytime soon, except maybe in the fall. All right, so our yield curve continues to uninvert. This is a yield curve of short to long-term treasuries. We're seeing it begin to normalize. You're still seeing the short-term rates up around 4.8%. So your CDs and your savings accounts and things should be maintaining those 3 to 4% rates for you. Long-term treasuries have gone up to close to 4.8. This is about 4.4, 4.8%. That's impacting the housing market. You're still seeing the 10-year treasury is creeping up as well, and that's impacting the housing market. Okay, so when it comes to bonds, we're talking about, what's the duration we need to kind of take focus on. We here are still focusing more on short duration bonds, because until interest rates start to fall on the long end of the curve, we're going to see the value of those bonds. You remember that long-term treasury index I showed you, how it's gone down over the last 5 years. We think that might continue a little bit more, if you will. And so we're staying on the short end of those durations, and we're just trying to be tax aware of those things. First quarter GDP was revised, so it actually was down minus 0.5%. It was expected to contract a little bit by 0.2, but that was beaten to minus 0.5% contraction in the economy. That was mostly people trying to front run the tariff changes. And so we had a high amount of imports coming into the country, and that really offset the balance sheet. And so we saw that negative growth in the economy. We expect that to be positive next month. I'll show that in just a second for the second quarter. But, you know, things are weakest because of those big import changes there. That will settle down, especially once the tariff situation's under control and certain a little bit more. So the growth is rebounding in second quarter. Expectations are that the GDP will grow by 2.5% annualized rate in the second quarter. But what I want you to notice here is that we expect this to slow down. And that's where we're getting our 1.4% annualized growth rate for the 2025. That's okay. It's slower, yes. But I think once the tariff question is settled, we'll begin to see that. We've already, in this quarter, we've got the tariff deal signed with China. Canada is backing off. The EU is supposed to be finalized today. I know India is real close to doing that, getting that done. And those, Vietnam agreed to terms yesterday. And so we'll see that settle down a little bit. All right, the producer price index, this is the cost of producing goods and things. You know, this was changes we expected here in the second quarter. Get the consumer price index. We've talked about that already. I won't belabor that anymore. But let's talk a little bit about inflation a little bit more. So you may recall back in May, Moody's downgraded the U.S. debt rating to AA from AAA. It didn't really move the markets. You would think that would, but this is the third debt rating agency to downgrade the U.S. debt. The other two happened in 2011 when the S&P did that, and in 2023 when Fitch did theirs as well. I do want to talk about, the core CPI has come down. This is the core elements of the components of the index that the Fed watches closely. It has fallen. And M2, and that's positive for potentially cutting rates. The M2, which is the money supply, it has eased up a little bit. Continued and sustained growth in the money supply can cause inflation. We certainly saw that in 2021, 2022, when the government pumped in trillions of dollars into the economy. That we saw the M2 curve just go up high, but that has settled down a little bit, but it is still creeping up just a little bit. And an inflation drop is due to tight policy, not tariffs. That's important. We're going to get into that a little bit more. And we've already mentioned that we expect the Fed to hold rates steady here in July. Okay, like I said, the tariffs have yet to really make their presence felt with inflation. Now, we can go back over here, looking at the high inflation rates back from 2021, 9.1 was the high, and here in the early part of the year, we're around 2.4%. And this, just so you know, that when we talk about the consumer price index, it includes these components. We've done this little graph here to show you that the majority of the CPI, the weight of shelter cost makes up a big chunk of the inflation indicators. Transportation's next, medical care, food at home, those are all big chunks. And then some of the smaller pieces here. But we are seeing that inflation tail off. Inflation always exists, okay? It's important to remember that. It's when it gets out of control that it can put a lot of pressure on households. Yes, I know things are more expensive than they were a year ago. but that's natural in some regards. Where we get out of whack is when things go up 30 and 40%. We don't want to be like Brazil. All right, employment came out today. We added $39,000, $39,000 jobs. We expected 126,000. The biggest gains were in healthcare and leisure. That's good. Leisure growth means that we're seeing a lot of people spending their money and taking vacations, and that's positive. And manufacturing was up or down, 8,000 jobs. And a lot of that has to do with the uncertainty around the tariffs, whether or not that's going to impact manufacturing. And the jobless rate fell, like I said, down to 4. I think that was 4.1. Just depends on the press release. There were two different articles that came out this morning. One said 4.2, one said 4.1. And wages are still rising, but settling down from previous months. And job growth is continuing at a steady pace. We want to see that. No, it's not explosive growth, but we are still hiring, and unemployment is remaining calm. Really, folks, when you think about unemployment, 4% is considered, an unemployment rate of 4% is considered full employment when it comes to the economy. So we're still only slightly elevated when it comes to unemployment. Now, if you're unemployed and you want a job, you're fully unemployed. It's not 4.1% doesn't really mean anything to you. But from a standpoint of the economy, anywhere around 4% is pretty healthy. Okay, so employers are hiring less, as I said, because those job numbers were creeping down, but they did outperform in the month of June. And they're beginning to pay less. In other words, what used to we have to compete for people for positions, and there might be a prospective hire that would have multiple offers, and we end up having to pay more for those. We're not seeing that type of activity right now. People are moving jobs less, and that's putting less pressure on wages and hiring with there. International trade, I only got numbers from April. The trade deficit was a little bit less than expected, about $4 billion. But we'll see how that happens once all the tariff deals. So look, how did the tariffs impact growth? Okay, so we've got 5 different policy goals or policy impacts that can impact growth of the economy. And what we've done here is trying to show how different policy positions what effect they can have on inflation and growth. Okay, so higher tariffs. Well, that's going to have a downward pressure on growth. It will have a negative, even though this is pointing up, it will have a negative impact on inflation, meaning it might cause inflation to rise. We haven't seen that yet, but if we have impressive high tariffs on things, that will impact inflation somewhat. Immigration. If we lower immigration, yes, that will have a negative impact on economic growth. Most of the people coming into the country legally are actually adding value to the economy, not taking away from the economy, despite the headlines. Inflation will go up because there's fewer goods to go around, and that's important to remember there. What about fiscal? Is anyone watching the fiscal spending in Washington? The answer is no. Fiscal spending might have a positive impact on growth. It will be relatively neutral on inflation. I can tell you right now, they're still debating the tax resolution, the budget resolution, continuing resolution in Washington. Senator Hakeem Jeffries was doing the House version of a filibuster. He has been speaking over the last 6 hours, not speaking about anything, but important, but he's just trying to delay the vote. What about taxes? Lower taxes mean higher economic growth, and it's neutral on inflation. What about less regulations? Well, that can impact positively on economic growth and positively on inflation. Where we stand now, we see slightly higher inflation, we see slightly higher growth based on what's coming through Washington right now. Okay. Uh, Here's some data going back several years and showing you the effects of tariffs over time. This is really kind of interesting. I'm not sure why this chart didn't the text in here, but we're going all the way back to the 1800s to this one's called the Tariff of Abominations. And this is really just showing the overall effective tariff that we see now. Now, here is where we are in 2024, the green dot, and the white dot is the current effective rate, so somewhere below 20%. And if we enacted all the broad-based tariffs that were announced on Liberation Day, that would bring the effective tariff rate close to 30%. But we're still not seeing the impact on trade. We export the fewest of goods of any country in the United States. And as a percent of GDP, exports are just a small part of that. So I think what we're going to see is closer to the white dot here. Oops, I'm on the wrong side of the page. Closer to the white dot here as for overall effective tariffs. And you can see historically, these are not close to even where the Smoot-Hawley Act back in the 1930s, late 1920s, early 1930s. Now, that one was blamed partially on causing the Depression. That's not entirely true, although you'll probably hear that in the media. Deficits. The last surplus we had in the federal government was back in 2000. Our debt now is close to 100% of GDP. A lot of this is we're going to be surpassing World War II debt levels. Now, that was a lot of obviously wartime production and spending for the war efforts and things. I am concerned about the federal debt, but we have to put it in the context of, are we growing as well? And it is possible for us to stabilize our debt by growing out of our debt. I know that sounds kind of complex, but as long as we're not getting north of 120%, this is where you start to see countries like Greece, Brazil, Argentina that run into problems when their debt levels are way beyond the production that's going on, gross domestic product going on in their country. I don't like the debt. I don't want to settle my future generations of children, grandchildren, and great-grandchildren to deal with that debt. Congress has to get themselves under control, but no one's interested in that. I think we're seeing that now in Washington today. So some drivers of those are tax cuts, wars, crises, healthcare, COVID, an aging population. More people are in entitlement type programs like Social Security and Medicare. And all these things drive deficits. And it's not just the Republicans or the Democrats, it's both parties. They both are causing the problem, and they don't want to do anything about it. Because remember, I've said before that this, when you get to Washington, your purpose is to maintain power. It's not really about American people. And I know that's cynical, but that's what I believe, and believe that most of the people in Washington, while they might have the intent of helping Americans, it's all about staying in power. And that's why today you see just 50-50 votes. All Democrats vote one way, all Republicans go another way. But we're just polarized, and I don't know what it is. We've lost the ability, and I wonder if it's we failed to teach our children how to have a discussion calmly. Love to hear your thoughts. Love to hear what you think about what's our problem in this country. But we cannot have debate or open discussions with just about having polar opposites. There's no discussion or debate. It's I hate you and you hate me. And this has got to stop. But the point is that the current path that we're on is really far off any surplus that we had back in 2000. And I think that's important. Let's talk about the tax bill, the big, beautiful bill, the big, ugly bill, depending on what you believe or what channel news you listen to. Um, we still are going to be running deficits. I have been following this closely. I don't ever pay attention to the headlines. I don't ever pay attention to what politicians are saying. You know, there's an old joke that basically said, "How do you know when a politician's lying?" And the answer is when their mouth is open, because no one is telling you the truth, and no one does a good job of explaining what's really going on. The continuing budget resolution, the primary objective there was to extend the Tax Cuts and Jobs Acts back from 2017. If that is not extended, then you will be paying $4.5 trillion, have a $4.5 trillion tax increase next year. So everyone's tax rates will go up. I don't think anyone wants to do that, but that will be the impact if they do not pass this joint resolution, continuing resolution for the budget. By the way, just a little factoid. I don't think we've actually had a complete budget bill passed in the House since 1998. Someone can check me on that, but 1998 was the last time I can see. We've always done these continuing resolutions just to keep the government open and extend the current budget. So who knows what we're really operating off of? This could have been one of Bill Clinton's last budgets, and we're operating off of that. By the way, 2000 was the last time we had a fiscal surplus, and lo and behold, Uncle Bill was in the White House. Now you can kind of see here from this chart, looking at if we don't increase this is the deficit. Yes, extending the Tax Cuts and Jobs Act will increase the deficit, but it will lower the deficit over the next 10 years. That's how Congress does everything. They measure everything in 10-year increments. What's the impact on this? What's the impact in this 10-year time? What you're hearing from one side of the aisle is basically that it's going to increase the federal deficit $3.3 trillion over 10 years. That's not true. The way that the Congressional Budget Office does is they forecast out based on current tax law. They like the current tax law says these tax cuts we got in 2017 are going to expire at the end of 2025. So therefore, we must forecast out. That's where people are saying there's going to add $3.3 trillion to the federal deficit. And these are just deficits. This is not the debt. These are just annual deficits. See how they're changing the language on you to make you think this is a big deal? It is a big deal. But if they do not extend the continuing resolution for this budget, the tax cuts will expire. And a lot of things that are in the bill will not get passed, like the no tax on tips and overtime. I know a lot of us work overtime, and that would be a tremendous impact. But it doesn't matter whether it's a good thing or not to one party. It's just they don't want the other party to have a win. And I think that's a shame. Here we are, we're coming up on the 4th of July, our 249th anniversary of the American freedom. And this is how we run things. I think it's a sham. It's a shame. And there's lots of different things here that are in this bill. They're raising the SALT tax, the state and local tax deduction, up from $10,000 to $40,000. And this primarily affects those blue states, those Democrat-run states with high taxes. And here the federal government's giving them a break. But The big thing that a lot of people worry about is the potential cuts on Medicare and Medicaid. Folks, all this is false. There are no cuts in this bill dealing with any type of entitlement program. Hear me again. There are no cuts in this bill dealing with any type of entitlement program. They really need to have them, but the cuts, only in Washington we're not increasing spending as fast as we were before, can be called a cut. You follow me? Only in Washington can we have something that is going to reduce our spending over time, and we call it a cut. No benefits are being done away with. Now, the federal government will enforce Medicaid rules. If you are able-bodied and can work, you should work. You shouldn't be living off the government if you are able to work. And once again, I don't know how we can call a tax cut a tax increase and a tax increase a tax cut. It's just phenomenal to see what's going on in Washington. I don't pay attention to it. I try to read the bill. I try to read between the lines and see what's really happening. All right, enough. I'll get off my soapbox, folks. Sorry for boring you in that situation, but here's some important dates. Okay. Next week, July 8th, the temporary pause on U.S. tariffs will expire. Will we have another continuation? I don't know. Will more deals be worked out? I hope so. On July 14th, the European Union, their retaliatory tariffs will also resume. On August 12th, China is expected to resume their tariffs, but we now have a deal that should go away. And then in August and September, we're going to be having the debt ceiling debate. That will be whether or not how much Congress can increase the debt ceiling. Right now, it's at 36 trillion, I believe. Can they do more? Let your congressperson know how you feel about that. And then sectoral tariff reviews wrap up. This is where we may focus on individual sectors in the economy. But our outlook is we expect growth to slow but not stall. Good news, right? Growth to stall, but to slow but not stall. Same thing with inflation. I think inflation will be neutral. I don't think it's going to be lower than the 2% that the Fed tries to target, but I don't think we're going to see rising things. Now, we look at this every month. So, we can always change that. We always reserve the right to change it. And, if you ever listen to a bunch of economists on Wall Street, they're never wrong. They always change their mind, but they're never wrong. All right. I wanted to talk about this because this is really important. We follow this a lot. We follow this in our office because we use artificial intelligence for some things to try to make office processes run smoothly and things. But look at this chart on the left. These are the days that to reach 1 million customers. And we're going back over here to the Ford Model T. How long did it take for Henry Ford to sell 1 million Model Ts? It took 2,500 days. All right. So at least 7 or 8, almost a decade to reach 1 million customers. And with TiVo, I don't even have a TiVo, but it took 1,600 days. With the iPhone, took them 74 days to get 1 million customers. And with ChatGPT, this is the free online version of the artificial intelligence language bot that you can get free online, took 5 days. Technology is accelerating. AI adoption is on the rise very quickly. And you're going to see this impact a number of different things. I've seen a lot on social media where there's fake stuff out there and it looks real. So be careful what you pay attention to. Be careful what you act on. Make sure you always confirm. Put on the belt of truth, if you will, to discern what is really truthful and what's not. do your homework. Don't follow the herd, because that seems like all we have in America is just a herd. Gold has soared quite a bit in the last year or so, but gold always carries risk. Gold is very volatile. You have to be careful of that. Should you have some in your portfolio? Well, it depends. A lot of central banks have been increasing their accumulation of that, and that's a sign too. Let's talk about the S&P. I just want to throw this in there. Having an intra-year drawdown is extremely common. The average intra-year drawdown on the market is around 14% down. Okay. We probably have 1 to 2 more than 10% drawdowns in the S&P 500 per year. Sometimes we'll have 3 or more drawdowns of 5% or more. It's common. You are invested for the long haul. Be patient. I'm looking at some of these drawdowns here. I'm looking at 2019, a nearly 30% drawdown, and it ended the year up positive 10%. So be patient. You invest for the long haul. Don't react to markets without talking to your advisor. So how does this all impact you? Well, we know that it's important to monitor your investments. It's important for you to review your financial plan at least once a year with your financial advisor. If you do not have one, we'd be happy to talk with you and visit with you about that. Avoid reactions to the news. Just don't watch it. If you are in a situation where you're worried about something, call us. We'll talk to you about it. I might not know the answer, but I'll find it out for you. It is very important to remain calm and just plan ahead, folks. Educate yourself as to what's going on for real, because I don't trust anything in Washington. Now, that doesn't mean that I don't trust that Social Security will be there in 2 years. That's not what I'm saying at all. As I said before, you can tell a politician's lying when they open their mouth. Sorry if I'm offending your politician, but it's true. You need to make sure, if you're still in your 401k and you're still working, please don't go to sleep at the wheel on this. You need to pay attention to what's happening. I know when we came out of 2022, a lot of people were shocked that they had lost so much in their 401k because they thought they were diversified, and they weren't. They were holding a large portion of bonds thinking that they were being conservative, and those got hit the hardest in some ways. As we wrap up here, I'm going to look here for questions. 254-282-0495. Got a conversation going here today. So the answer is yes. The question was, doesn't the deficit increment increase the debt? Absolutely. Absolutely it does. We need to spend within our means. Why can't the federal government spend within their means? Seriously. And it used to be a one party. It's everybody now. Everybody loves the party of spending more than we bring in. I don't know how this is not something that is slapped in the head every day by each and every congressman. We need to have a parliamentarian that slaps them in the head as they come into the chambers, because we cannot spend more than we bring in. And government policies and regulations often lower tax collections because of the onerous regulations that they put in place. And I'm tired of it. And I hope for once people will stand up and vote out these cronies in Washington that keep spending your money and spending more than you've given them. I don't care, and I'm not really concerned about your view about certain types of programs and things. That's fine. I support that. There should be a generous debate. But the bottom line is we have to spend less than we bring in. We don't do that in your household. If you do that in your household, you rack up credit card bills and debt and things, and you end up having to go into foreclosure. We should have gone into foreclosure in our federal government a long time ago. But we have the ability, we have the fiat currency, we can print our way out of debt, we can grow our way out of debt, but it needs to stop. We need to get things under control. I encourage you to contact your lawmakers and tell them to get their act together. And when they give you the spiel about how hard they're working, say, no, get it together. All right, that's my soapbox for today. All right, folks, we thank you for listening in. A lot of positive signs in the economy, a lot of uncertainty still ahead when it comes to tariffs. And of course, we're always watching worldwide distortions, whether it be a war in Ukraine or a war in Iran. We have to be cognizant of those things. And we do not see them causing us problems right now, but things can change. Keep an eye on things. Give us a call if you have questions. As always, you can send us a text at 254-282-0495 or send us an email at info@clearvistafinancial.com. Thanks, folks. You've been listening to ClearVista Financial Perspectives, and we will do this again next month, the first Thursday of August. Have a great day.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.